All right. So step 4 is determining your financing strategy. So obviously you have a little bit of math to do, I think, in your own scenario to determine whether or not it makes sense to buy all cash or whether it makes sense to use financing. If you're planning on using financing, there's some real tactical steps that I think you have to implement. I mean, the biggest question that I ask people is, can you qualify for a loan? You may have looked at those two scenarios and recognized, wow, I am not dealing with a lot of capital. I need to start chipping away at this with what I have. But can you even get a loan? Have you talked to an experienced lender to know if you have, a good credit score, a good debt to income ratio? Did you maybe lose your job during COVID? Were you furloughed for a short period of time? Does that have any impact on your ability to get a loan for the next year or 2 years? There's a lot of factors that have got to be considered. So I always say, prioritize speaking with a lender. So we've already kind of talked through these steps. I mean, we've decided what kind of car we want to buy. We've put the keys in the ignition, but the financing is the gas in the tank. So if you want to go somewhere, we've got to know that we have financing, that we can put gas in the tank. So I think it's extremely important that you work with an experienced lender, one who specializes in working with real estate investors. And so lucky for you, we have already kind of found a couple lenders that we recommend. This is a loop showing you when you're logged into the investor portal, where you can find the list of lenders that we recommend. And again, all of these lenders specialize in working with real estate investors. Most of them work almost exclusively with real estate investors, so they really understand exactly what it is that you're wanting to do and all of the different levers that they can adjust. And I've found that our lenders tend to say yes a lot more than just regular conventional big bank lenders, especially right now during the times of COVID, where it seems that the qualification criteria is just getting more and more strict. So connect with one of our preferred lenders. They're licensed in all the different states where we have property teams. So you don't have to worry about, have I even decided on a market yet before you engage a lender. They can work in all of the different markets where we have property teams. All right, a couple other points I want to make, because these are questions that come up all the time relative to financing strategy. A lot of people are saying, okay, my financing strategy involves accessing equity that's in another property that I have, whether that's my primary residence or whether that's another investment property. So I've got these 3 kind of primary ways that you can tap into equity of another property. The first one we touched on again a little bit in last week's class. The 1031 exchange is a great way to tap into equity of an investment property. It allows you to sell that home and defer paying those capital gains taxes, but you have to reinvest that money in replacement property. So if you're planning on using that money to buy homes anyway, you should definitely be considering the 1031 exchange strategy so that you can delay your payment to Uncle Sam. The second way is a HELOC, a home equity line of credit. This may be an option on your primary residence. This is something that's worth, I think, exploring again with an experienced lender to find out exactly how much equity you could tap into. HELOCs are not always an option on an investment property, though I've heard it's possible. There are very few lenders who will do it. So if you have a great lender who will give a HELOC on an investment loan, you might send me an email so I can know who that lender is, because we're always looking for someone who can do that. But certainly on your primary residence, a HELOC is an option. What I would tell you about tapping into the equity of your primary home is to be very conservative. I mean, this is your home, right? This is where your children live. This is your sanctuary. So I don't think you want to lever out your primary residence in a risky way, especially if you live in a high cost market. If you're in a bubble market where home values just don't really make a whole lot of sense, I would be very conservative about how much equity I'm tapping into on my primary residence, but it's definitely an option. The third option is a cash out refinance. So I am particularly fond of the cash out refinance because it allows you to basically take out a new mortgage. So you're resetting the mortgage on an existing property and they're giving you the difference. They're giving you the equity. Most banks require that you leave 25% equity in the home and then they'll give you the difference. Obviously, there's going to be some transaction costs. Those services aren't free, so you will have some closing expenses with a cash out refinance, but you get that money tax-free. and you can do with it what you want. So you don't even have to, go and buy more real estate. I would. I mean, don't go and do a cash out refinance to buy a car. Go and use it to buy another property. But this is a great tool. The thing you got to be careful with the cash out refinance is that it's going to change the principal and interest payment on the investment property. So I love the cash out refinance strategy for linear markets that are more cash flow focused, that don't have just really steep appreciation, because I know after I've had so much principal pay down, I can come in, I can do a cash out refinance. They're going to reset my mortgage to the new market value, but it's not going to be a whole lot more. And those rent to value ratios are still going to be such that that property would positively cash flow. Whereas if I'm looking to do a cash out refinance strategy in a growth market, and that property has had extreme appreciation, I'm resetting that mortgage at that really high property value. And if you remember from last week, we talked about how as property values go up, rent prices also go up, but rent to value ratios get squeezed as property values go up. Those rent prices will find their ceilings long before. So what you want to consider is that you don't throw away the stability of an investment in order to do the cash out refinance. I would absolutely engage, again, an experienced lender with making this determination. So they can provide you with a fee sheet, of, hey, if I wanted to pull out $20,000 out of this home, what would that change my mortgage payments to, and how much money would I see coming back to me, and how much equity would I be leaving in the home? So engaging with a knowledgeable lender is great. But these are kind of the three ways that I see being kind of viable options for tapping into equity in another property. All right, and then determining your purchasing strategy. The timing is also going to be affected here. So how quickly can you save up enough for a home? You can look at your ability to save, my income, minus all of my expenses, how much do I have left over each month, and what is a feasible amount, and maybe that's going to dictate your purchasing strategy and the pace of how you acquire them. You want to consider your debt to income ratio. It's very possible to acquire multiple properties at the same time. You don't necessarily have to wait. If you have a certain amount of capital that you want to deploy, you could buy all 4 properties at the same time. What the lender is going to look at is your debt to income ratio. Can it support acquiring 4 properties at once? Once those properties get leased up, banks can look at a certain amount of that rental income as actual income. And so if you're buying the right kinds of property, your debt to income ratio should get better every time you purchase a rental property and get it tenanted. But depending on what your DTI is, you might not have room to buy 4 vacant properties at one time. Maybe you have to buy 2, maybe you can buy up to 2 at a time. But once you get the first one tenanted, now you open up where you could buy a third. So again, engaging with a knowledgeable lender really helps you understand your debt to income ratio and how that could impact your pace of acquisition. All right, these last 2 bullet points, I think they speak to our example earlier. If I have more money available to invest, I can create the cash flow goal, or I can create life-changing cash flow in less time. But if I have less money, that's okay. I just need more time to hit that same cash flow goal. Because I have all 5 income streams paying me, I can get into a property today and allow, appreciation to start accruing, start taking advantage of the tax deductions, start taking advantage of the principal pay down. I can still hit my goal with less capital. It'll just take a little bit longer for me to get there. So, don't be discouraged. I think if you're looking at these numbers and going, where am I going to find $500,000? You don't have to have all of that at once. If you have time on your side, then you can do more with less. Oh, did I skip ahead? No. All right. So determining your purchasing strategy. Oh, let me back up a little bit. So I introduced this long slide incorrectly. So we were previously talking about the financing strategy and the capital and how the financing is going to kind of fuel our acquisition. So now we're actually getting into purchasing and deciding what I'm buying and when I'm buying it. So the first point to that is timing. The next point to that is property type. So you want to consider single family versus multifamily. I get this question all the time, which one's better? And the answer is it depends. I can argue both. Single family homes tend to be a little more liquid, so they're easier to sell. There's just more people buying single family homes. You can put a property up for sale and an owner occupant could buy it, another investor could buy it. But if I put a multifamily property up for sale, I have fewer buyers. I'm more than likely selling that property to another investor, or I'm selling it to one of the few owner occupants out there that wants to live in one side of it, which some would argue there's more of those now than there was before, but single family tends to be a little bit more liquid. Multifamily gives you some economies of scale. So you can usually get more doors. You can usually get a duplex for less than the price of 2 single family homes. And usually your rent to value ratios are a little bit better. So, single family homes can tend to appreciate a little bit quicker, generally speaking. So you kind of can look at, okay, do I want max cash flow with a multifamily, or do I want maybe a little bit more appreciation with a single family? So kind of be aware of how those are different. Now, neighborhood classification. This one gets really tricky. If you've watched some of our property overviews, you've heard us say this before. The classification of neighborhoods cannot be applied consistently to all markets. It's really important to understand the classification of a specific market. A B-class property in Dallas-Fort Worth may look and does look entirely different than a B-class property in Chicago, Illinois. And so you need to kind of understand and kind of properly calibrate yourself to what is the classification system or scale in the market that I'm considering. And then I think this last point kind of speaks to the classification system. Consider risk versus reward. These C-class neighborhoods, they have great cash flow projections. You're going to see really great rent to value ratios. You're going to see cheaper property. And so that's going to be really enticing, but you have to recognize that oftentimes where there is more reward, there's also more risk. And then the opposite being true as well. If you look at A-class properties, yeah, maybe on a pro forma, when I'm looking at projections, those returns are not super impressive, but my risk factor has gone down tremendously. So maybe that's my comfort level and that's where I want to focus. But you're really going to kind of calibrate yourself to what is my risk tolerance? And I think, what is my financial situation? Can I bear a high risk product? If I was an investor who had very little reserves, I had very little savings, and I was buying my very first investment property, I would personally steer you away from buying a C-class property, because those properties tend to be a little bit ebb and flow. Tenants are a little bit more unpredictable. They care a little bit less about your property. So usually turn costs are higher in those C-class properties. A lot of times they're older homes as well, which sometimes those can have more maintenance. So if I'm someone who doesn't have a big reserve account, I don't necessarily want to go and chase the most high risk asset. So calibrate your purchasing strategy based on your assessment of risk. All right, and then what about market diversification? I get this question all the time too. Should I diversify across a couple different markets? Should I focus on just one? And again, the answer to that is it depends. It depends on what your goals are and what your comfort level is. Some would say, hey, I want to buy 4 homes in one market. And the benefit of that is that I have one property manager that I'm dealing with. And now maybe I have a little more leverage with that property manager. They know who I am because they manage 4 different doors for me. It's also easy for me to get in contact with when there's a problem with any of my properties. I don't have to remind myself, now wait, which one is the manager for that one? I have one contact person. Maybe you want to try 2 homes in one market and 2 homes in a different market. I think that's a good strategy to kind of test out a different area. I also like the idea, I know I mentioned this in the last presentation too, but I like the idea of diversification, not just from a perspective of market, but market types. So maybe I want to buy 2 homes in a cash flow focused market, and then balance that with 2 homes that have some better appreciation potential to create that market diversification. Or maybe you know that this is just a small step in the direction of a much larger plan, so you want to cast your net out wide and buy 4 homes in 4 different markets so that you can really test them out, really get to know them, and potentially scale in 4 different markets, or maybe inform acquisition 5, 6, and 7 based on real-time experience and real interactions with 4 different property teams. So there's no right answer to this. I think, again, it kind of comes back to your risk assessment. I think it comes back to your goals goals, if you're looking at, hey, I'm close to retirement, I'm all about simplification, I want dependable cash flow, but I also don't want to talk to 6 different property managers, then I can totally see why diversifying across fewer markets would make more sense for you. All right, so let's say I'm going to get to another kind of scenario so you can see some more kind of real-time numbers, but let's say you've got $100,000 to invest. So of course you could choose to buy one property outright in cash and have that, you know, $700-ish a month of cash flow. Or you could buy about 4 properties with 20% down on each, and then you would have the appropriate amount for reserves. So you'd have, you know, $5,000 reserves available for each of those doors, keeping you really safe there in case or for when there are some maintenance and vacancies. So we got 2 options here. I'm going to work through the next scenarios, focusing on the second, the latter. So let's say you're wanting to buy with leverage. So the question becomes, okay, do I pay off these homes? And I tell you, this was the question of the week this week for me. I had so many people watch the first session and say, okay, so when is my timing now for paying off these homes? And again, the answer is it depends, but let's walk through some of these scenarios. Let's say I'm buying 4 homes and I'm going to implement the debt snowball strategy to pay off those homes. So I'm going to take, and I'm being super conservative in this example. I know previously I had used a cash flow estimate of about $300 a month, but I'm being ultra conservative here and I'm using only $200 a month. So each one of those homes is cash flowing $200 a month. I'm going to take all $800 from all homes and I'm going to apply it towards the principal of the first home. If I did that, I would reduce the mortgage time on that home. I would pay off that home in 8 years. And so then if I took all of that cash flow now from that paid off home, so now my cash flow went up on one of those doors, and I now took all of that cash flow and applied it towards the second property, that second home is paid off in 6 additional years. Now, if I took all of that cumulative cash flow and applied it towards the third property, I could pay it off in 4 years. And then of course you see the final property I'm paying off in 2 years. So I have expedited the payoff schedule for my portfolio. So now I own all 4 properties free and clear, and I'm cash flowing about $4,000 a month. And again, that's assuming no rental increases over that 20-year time frame, which is unlikely. Rental prices are probably going to go up in 20 years. So that's a super conservative estimate. And you can see how this strategy could change and differ depending on the amount of cash flow that you have. But this is 100% a strategy that I hear a lot of investors implementing, is snowballing their cash flow to pay off their properties and really just collapse them on each other. The other scenario is to buy 4 homes, but then allow your cash flow to replenish your savings so that you can buy more property. This is an ideal plan for someone who has more time. So if you're young, I personally have a really hard time understanding or justifying paying off a home in your 20s or 30s. And I think it's kind of in conflict with, the paradigm of today that debt is bad. We're all taught that. And so I feel that conflict internally as well. But if you have time on your side, you can implement this strategy and just continue to scale incrementally. You're adding another door, and you're allowing all 5 profit centers to work for you over that 30-year period. Eventually, I totally see the reasoning for wanting to start gradually paying them off, but I definitely personally in favor of some leverage. And the question that I ask people when they're trying to figure out which one of these strategies makes the most sense for them is, what phase are you in? Are you in an expansion phase? I'm looking to scale. I'm wanting to grow. I'm wanting to really take advantage of that time value of money. Or am I in a consolidation phase? I'm looking to create efficiencies. I'm looking to have better properties. I'm looking to own fewer properties. I want life to get really efficient. And so you've got to kind of, again, look at your goals, look at where you're at in life, look at the timeline that you have and make that decision. Am I expanding, wanting to scale, or am I consolidating, wanting to create efficiencies? All right, step 6, determining your buy box. I think this is one of the most complex steps, but it starts with speaking with your investment counselor. So we are very familiar with these different scenarios that we've talked through today, and just kind of having those reality check conversations based on capital limitations or time limitations. So we love engaging with our members on their specific situation to kind of help them nail down and identify what strategy works for them. And once we can kind of identify some of these concepts that we've set out already, you start the process of exposing yourself to different markets by watching the market webinar series that we have on the investor portal. Now, to have access to these market webinars, you've got to be a member of RealWealth Network. So we'll talk about how you can do that here in just a bit. But we produce a ton of content that we reserve. It's exclusive for RealWealth members, where you can get to know a market, get to know the company that we work with in that market, get familiar with their inventory. And so once you started exposing yourself to these market webinars, now you're in a position where you can start creating your own relationship with the property team. Again, they're independent companies from us. We don't own them. We can't tell them what to do. We can't guarantee your experience with them. So you've got to initiate that relationship with them to take next steps and get access to all of their inventory. If you can visit the market, we strongly encourage you to do so. Now in the times of COVID, this is easier said than done, but all of our teams are willing to do market tours again. So when you feel comfortable traveling, we absolutely encourage you to do that. I would say that about 50% of our investors are traveling to markets before buying there. So it's not a requirement. You don't have to, but I do think that there's some value there, and I think it makes your decision all the more informed. I like to kind of share some personal experiences with this one because, again, I can argue both sides of this. Maybe this is my personality. I can play devil's advocate for anything, but someone says, have you visited all your properties that you own? And my answer to that is no, I haven't. I've bought some properties sight unseen. And they say, do you regret that decision? And the answer is no, I don't. I have put a property under contract before going to a market, before seeing the area. And when I did travel there, I was scared and felt a little bit like, oh my gosh, this is outside of my comfort level. This is not what I thought it would be. And I started having all kinds of regrets for doing this. But when I talk to my mentors, they can kind of remind me of the bigger picture, help me keep the main thing. In this specific instance that I'm recalling, I pulled out of that contract. I didn't end up buying the house. I gave in to kind of the emotional side of things. So would that deal have worked? Possibly. The other side of that is that I have homes that I have bought long distance, and they perform great. They're awesome. I'm getting great returns. I'm getting great tenants. I have great property management. I never went there. No, I didn't see it. And then I go to it after the fact and see the house, and I can see, wow, if I had seen this before, I probably wouldn't have bought this. And look at what I would have missed out on. So, I think it is important to understand the market and to conduct good due diligence. But I also recognize the bias that I bring into my analysis process. And just because it's a neighborhood that I'm a little bit uncomfortable with or that I'm scared of doesn't necessarily mean that it won't do what I'm wanting it to do. So just keep that in mind. All right, and then monitor listings. So I think this is key. Up your exposure to inventory. The more deals you look at in a market, the more familiar you are with price points, the more familiar you are with rent to value ratios, and you're not just relying on the opinion of the person that's trying to sell you the property. So increase your exposure to property listings. Get very familiar with what's a good deal in that specific market. So you are really refining your personal buy box. You're getting very, very well calibrated to the type of deal that you're looking for. All right, here's my caution. Beware of analysis paralysis. There is a step 7. I see a lot of people get stuck on step 6, and this just becomes a loop. And they understand real estate, they recognize the benefits of it, they speak with an investment counselor, they're watching all these webinars, they're analyzing listings, but then they want to speak to the investment counselor again and analyze more, and they're just going round and round and round, fearful of maybe not having all the answers. And to that, I always say that You can't eliminate all the variables that exist in real estate. There's a reason why there are 5 profit centers. There's a reason why the returns are, I think, so much better than any other asset class, because there are more risks and there are more variables. So beware of getting stuck in this loop. The only thing that makes me different from any of you beginner investors who don't own a property is time and action. I learned by doing. I didn't have all the answers when I started doing this, but I realized that, hey, with each transaction, I'm becoming a smarter investor. I'm figuring out what my preference is. And I think that's another one of the benefits of connecting with an investment counselor, is that you can borrow our lessons learned and hear kind of our 2 cents on, hey, what worked for me, what didn't. Does it mean it's going to translate and be applicable to you literally? Not necessarily. But action has informed so much of my strategy. And I know that I'm becoming a better and better investor with every property that I buy. So be really careful not to get stuck in this loop of due diligence and trying to find a deal. Now, what I don't want you to hear me saying is, I don't want you to hear me say that you should just buy something, like just get out there and buy a deal. That's not what you should do. You need to diligently execute. So you still have to be very cautious. You still have to take control of your due diligence and, understand the market, understand the risks, understand some of those variables, recognize that you can't control them all. And we've made this pretty easy for you. We've put together an investor checklist, which we have on the website to kind of guide you through this process. So on that checklist, you'll find some of these tips. We recommend you order a full home inspection. Don't ever buy a property based on, a previous inspection report or, a good faith comment from a seller. You 100% need to order your own full home inspection from a licensed third-party home inspector. What I always do after a home inspection too is I get on the phone with the inspector and have a verbal conversation about the report. I read the report first. Don't call them and ask them to read their report to you. Read your report, write down a list of questions or concerns that you have on that report, and then schedule a call with the inspector to talk through it. I always learn more about a property through an anecdotal conversation than I do just by reading a report. So definitely get that inspection, and I think go a step further and talk verbally with your inspector afterwards. Order a home appraisal. Don't overpay for a property. Understand your contract contingencies. So read your contract. I know that, there's a lot of legalese in these contracts and they can be kind of mind-numbing to read, but you need to read them and understand what kind of contingencies exist. We recommend that you enter contracts where you have an appraisal contingency and an inspection contingency, so that, if you find something unsatisfactory in inspection or the property can't appraise, you have a legal way to get out of that contract. Consider different measures of asset protection. Consider whether or not you want to set up an entity structure, LLCs, or maybe you want to just get an umbrella insurance policy. This is a rabbit trail that I don't have time to go down today, but we did just recently record a great 4-week series with a wonderful attorney that specializes in real estate tax strategy and entity formation. So there's about 6 hours of free legal advice. Log into the investor portal, check out the recent webinar section, and you can see the 4-part series for asset protection. But consider whether or not that's something you need to start before you acquire your first property. But again, I would caution you, don't get stuck on the asset protection stuff. If you never have any assets to protect, you didn't need it to begin with. So just make sure that you're informing yourself for action. And interview property management. I think the property management piece can't be overstated. You've got to understand the screening process. What are they looking for when they're screening a tenant? What's the income requirements? What's the credit score they're looking for? What is their criminal background check process? Understand how they select tenants, understand what fees you're responsible for. And I think you should begin this property management process before you actually go under contract on a home. As part of your due diligence on a market, also be talking with their property manager so that you can get to know them and make sure that they meet your criteria as well. So refer to and follow our investor checklist. This is a really great tool for you, and it gives you kind of a roadmap of how to diligently execute your plan. All right, so those are the 7 steps. Clarify your goals, define your current situation, Discover your purchasing power and be realistic about it. Determine your financing strategy, engage a qualified lender, talk about cash buys versus levered buys and how do they help you get to your goal. Determine your purchasing strategy. So start refining whether it's single family, multifamily, whether it's all in one location, and then start really working on solidifying your buy box. What kind of home am I looking for? Who am I considering working with? And then number 7, diligently execute. Pull the trigger, get into a deal and start that learning by doing.